finish what I prepared for today. I'm thinking next month we'll actually take a break from stocks and we'll talk about personal finance. And but we'll see. If we can't finish today, we'll have a part two of this, and then maybe in December we'll talk about personal finance. Now, starting from November, this meeting will be on the first Saturdays. So the next meeting will be on November the 2nd. So and everybody needs to sign up to be notified. So if and my ask is please tell other people if you're getting one thing or the other from this. The only thing I would ask is just share this with people. I always send out flyers, and if you need me to send out the flyer to you, I'll be happy to do that and send the link to register and so on. So let's dive into it. So we said we're going to talk about how to manage risk as an investor. You've probably heard this cliche, buy low, sell high. Everybody just wants to buy low and sell high. While it's true that for you to actually make profits, you buy low, you sell high, it's not that easy. If it's easy, everybody will just be making money from the stock market, right? But one of the reasons I'm doing this is that I know so many people start investing in stocks, and because they see that they are losing money, they just give up, you know. And sometimes people see red in their account, they panic, they go sell their stocks, and they never invest again. It's very possible to make money in the stock market, but there are risks involved. The stock market does not go on a straight line. Pick any stock, look at the chart. It doesn't go on a straight line. You will see there will be time it to go, the price will go up, there will be time the price will come down. That means for everything, and it's not just stock, for every investment, there's an associated risk. So when we talk about investment and risk, we're talking about the possibility that you will get a lower return than you expected. Or maybe you won't even get a return at all. Maybe you will even lose money. It's possible to lose money in the stock market. So, given the fact that it's possible to lose money, how can someone be successful? How can someone invest make money rather than losing money? It's being, to achieve success in investment is actually a matter of balancing risk and the reward. Usually, the higher the risk, the higher the reward. The lower the risk, the lower the reward. So, to understand risk, there are certain things. I have a few key points here that determines the different kinds of risk involved in the stock market. Market risk. It's basically the risk that an investment would decline due to market conditions, maybe like economic condition, maybe due to political instability. In a few days' time, we are going to have an election in the United States. Anything can happen. Irrespective of who even gets elected, the stock market could be impacted. So how can you make sure that no matter who gets elected, no matter who becomes the president, your portfolio is not negatively affected? And it's not just election. There are just so many things that can affect the market. In 2020, when we had COVID, in March of 2020, there was a decline. If I remember correctly, it was probably up to like maybe 20%. I don't remember the percentage, but there was definitely a decline in the general market, not just one stock. Ukraine Russia war caused a decline in the market also. So there are certain things that can cause a decline in the market. But it's important for an investor to understand that a risk or whatever is going on is just going on generally in the market, not just one stock. Like maybe like a month ago or something like that, I was hearing people saying, there's been this buzz about Nvidia. I was hearing people saying, oh, Nvidia is going down, it has reached its peak, it's going down and things like that. But I looked at the general market. It's not just Nvidia. It was the general market that was not doing well as at that time. So there are times that people just panic and go sell a stock when the problem is actually not with that stock. It's a general market condition. So it's important to be able to identify a general market condition and not just act with impulse. Then there's a credit risk, which is basically a risk that a company will not be able to pay back the loans that they got. It doesn't necessarily have to be loans. It could be that, okay, maybe you saved your money in a bank or something like that. Maybe, well, usually if the bank is backed by FDIC, Federal Deposit Insurance Corporation, you will still get your money back. But if you invest in the stock of one company, if the company fails, you will not get your money back. For example, I invested in SIVB. The company has failed. My investment is gone. So the credit risk mostly impacts bonds and CDs. So you have to understand that risk. Before you buy CD in a bank, you have to look at the finances of the bank. You have to look at the strength of the bank so you don't lose your money. The same thing with bonds. Then the liquidity risk. It's basically a risk that you may not be able to sell your investment at the right time that you really need to sell it. Or maybe you will sell it below the actual value. An example is if you buy a CD, if you buy brokerage CD, for instance, if interest rates has gone down, the new issues the issuer of the CD will prefer to issue new one, right? So if you want to sell the CD again, it has to be brokered CD rather, not a general regular traditional CD. You cannot sell it. If you try to get your money back before maturity, you get penalized. But for brokerage CD, it's possible to sell it. The only problem is that if the interest rate has gone down, your CD will lose value. You may not even be able to sell it. So you have to look at something like that. Then the inflation risk. There's a risk that if I've invested in an asset, the return from that asset may not keep pace with the current inflation. I always tell people, if the only thing you do is put your money in a bank account, you are losing money. You may open your bank account, look at the money, you see the money there, but the value reduces each time, because of the inflation. So when you are investing in an asset, you need to compare the rate from that asset and the inflation rate. Then the interest rate risk. I talked about that briefly when I was talking about liquidity. Like when interest rate goes down, the value of existing bonds and CDs will be lower. So those are the things you have to consider. Maybe you may want to do something like having a ladder, CD ladder, create a CD ladder, right? That could help you in hedging against interest rate risk. Now, before we talk about how to mitigate risk, it's important to talk about risk tolerance. We don't have the same level of risk tolerance. The risk that somebody is able to take, I might not be able to take it. It's wrong for me to just invest in an asset because somebody else has invested in it. Because it might be okay for that person's risk tolerance. Maybe it's not okay for me. So you have to check your own level of risk tolerance and determine whether the asset you're trying to invest in is good for you. So when talking about risk tolerance assessment, there are two things that you need to consider: the personal risk tolerance and the time horizon. For personal risk tolerance, you have to understand your own risk tolerance and you should invest accordingly. Again, don't invest just because there's this thing that maybe people will just hear that, okay, this investment is returning a good rate, and people just go put their money in it without trying to check how the risk involved in the asset or in the investment. So before you invest in an asset, there are two questions you need to ask yourself. Number one is, if you lose part or all your investment, will you lose your sleep? Meaning, you invest in an asset, the price goes down, or maybe you even lose all the money. Are you going to lose your sleep because of it? If you are going to lose your sleep because of that, you may not want to invest in that asset. Maybe that asset is not for you. The other question to consider, to ask yourself is, are you satisfied with the level of volatility of that investment? There are some investments that have good yield, but they are very volatile. An example is crypto. I know people make a lot of money from cryptocurrency, but me as a person, I've determined I would never invest in it because it's too volatile for my risk tolerance level. There are people that have that are able to take more risk than I am, right? Those can invest in it. But for me, I know my own risk tolerance. I know I cannot afford to go into cryptocurrency. So the other thing you need to consider is the time horizon. For how long do you want to invest? The time horizon will determine your strategy. But before I continue talking about time horizon, let me distinguish between two terms: trading and investment. While people use them interchangeably, even me, I use them interchangeably, they don't mean exactly the same thing. Trading is usually short-term focused. You trade, you buy an asset thinking that within a short time, the asset will increase in value. You sell the asset, you make money. That's trading. It's usually short-term focused. And for trading, if you're trading in stocks, you need the knowledge of technical analysis. But the risk involved in trading is higher than the risk involved in investment. Meanwhile, investment, on the other hand, is long-term focused. Maybe in the next 3 years, you want to buy a house and you are investing in an asset that will yield money so that you can buy the house. Or maybe you are investing for retirement. Those are long-term. Now, coming back to the time horizon. Again, trading has higher risk than investment. When you know that you are investing for a long time, even if the price of the asset goes down, you may not worry yourself because you know that it will eventually go up again. But for somebody that is trading, it's important to actively monitor your assets. And if the price is going down, if you think that the investment is no longer worth it, get out of it as soon as possible. Now, people make mistake of staying in an investment when the price has gone down, thinking that, oh, they cannot afford to lose money. Now, as an investor or as a trader, you get to determine your own strategy. Don't just do something because somebody said it. And I'm not advocating that you necessarily have to sell your investment. But let me show you one thing. I did just before this meeting, I did a little calculation. I'm going to share it now. Assuming you invest $100 in a stock or any asset, the price goes down by 20%. The new price will be 80%. By what percent will the stock need to go up for you to break even, for you to go back to the initial investment? When a stock or an asset has reduced in price by 20% or in value by 20%, for you to go back to the initial price or value, it has to increase in 25 by 25%. Remember, it decreased by 20%, but to go back, you need it to increase by 25%. I did a validation here. You can see if $80 increased by 25%, that will go back to 100. Now, you may think that, okay, maybe it's not a significant difference between this 20 and 25. If it reduces in value by 30%, you need it to increase by 43% for it to break even, to go back to the original value. By 40, it needs to go down, go up by 67%. Let's go jump to 90. If an investment loses 90% of its value, you need it to increase by 900% for it to go back to the initial investment. And for an asset that has already lost 90% of its value, what are the chances that it's ever going to increase by 900%? I did this calculation so that you can know that it's important, especially when you are trading. It's important to actively manage your portfolio. And if the value is going down, it may be important to get out of it rather than staying in it. For certain assets, the more you stay in it, the higher the losses you incur. Again, I'm not advocating for you to sell your stock at loss, but I'm just showing you the data that supports getting out of a trade as soon as possible when it goes bad. Now, having said that, how do you mitigate investment risk? You need to know something here. I use the word mitigate. I did not use eliminate, because you can never completely eliminate investment risk. The reason you are getting a reward or return from an investment is because there's an associated risk. And as I mentioned earlier, the higher the risk, the higher the return. So you determine the level of risk you are willing to take, and that will determine the yield you can get from it. So now, while you cannot completely eliminate risk, you can mitigate it. You can lower your risk. You can lower your risk exposure. So let's look at a few ways that by which you can mitigate risk. Diversification. So this is very important. Diversification is basically a way of allocating capitals such that you reduce your risk exposure to a particular risk. When you diversify, you reduce your exposure to a particular risk. And there are different ways to diversify. There's an asset allocation. You diversify by allocating your asset, meaning you can spread your investment across different asset classes. For example, you can, if you have some money, let's say you have $5,000 that you need to invest. It may not be the best to put all the $5,000 in stocks. Maybe you want to put a percentage of that money in stocks, another percentage in bonds, Maybe another percentage in maybe CDs or something like that. Sorry. That's asset allocation. When you spread your investment across different assets. By doing so, you are reducing your risk exposure to each of the different assets that you have invested in. So let's say you have invested in stocks, you have invested in bonds, you have invested in real estate. If there's an issue, let's say there's an issue with the market, the stock prices have gone down, maybe the bonds may not be so much affected. Maybe the real estate will still be doing well. So you may lose money on one asset, but you still make profit in another asset. That's asset allocation. Mutual funds and ETF, you can still consider these as part of asset allocation as well. We are actually going to have a session on mutual funds, ETFs, and an index fund. But let me just give a brief explanation of a mutual fund and investment fund. Imagine if maybe during Thanksgiving, you want to give, or maybe Christmas. Sometimes you go to stores like Costco, or Sam's Club, and you see certain gifts, you see gift baskets. You take a basket, there are different gifts, maybe there are fruits, maybe there are chocolates and some other things. You don't have to buy those goods one by one. You just buy a basket and it already contains all of the different gift items that you need, and you give that to someone. Funds are similar to that. Both mutual funds and ETF are baskets of equities or stocks, but they are different. ETFs can be traded the way you trade stocks. In fact, sometimes when you see the ticker symbol of an ETF, you may not even know it's an ETF, right? You can trade it the way you trade a stocks any time of the day. Mutual fund, on the other hand, can only be traded once in a day. And in fact, the word traded, when it comes to mutual fund, you need to quote it, because in the real sense, you are not trading it. You can buy only once in a day. It is you bought it at the net asset value, NAV. Again, we'll come back to that and I will explain more about it. Now, the advantage of investing in funds, be it mutual fund, ETF, or index fund, is that while a single stock might lose value, there's a good chance that the whole of the fund will never lose value. An example is S&P 500 ETF. I explained, I believe it was the last meeting, that S&P 500, even though you see 500, it actually contains 503 stocks, because 3 of the companies have multiple stocks. Now, why maybe 1, maybe 2, 3, companies may fail or fold up? There's no way all the 500 companies in S&P 500 will fail at the same time. Or maybe the value of some of them will go down, but there's a good chance that out of the 503 stocks there, some of them will still go up. That's why, especially for people who are just learning to trade or invest, it might be a good idea for them to start with ETFs and mutual funds. Now, sector diversification. If you're familiar with the stock market, you can see that the companies in the stock market are divided into sectors. They have GICS sectors, they have industries, they have sub-industries, and so on. Now, when you spread your investment across multiple sectors, you are diversifying. and you are hedging against risk. It's possible that maybe one industry or one sector will not do well, but maybe another one will do well. Even during recession, there are still industries that may do well. For example, healthcare. No matter what is going on in the economy, when people are sick, they still go check themselves out. They still get the necessary healthcare that they need. No matter what is going on in the world, people will still buy groceries. So certain industries may not be so much impacted when certain things happen. That's why it's good to spread out your what's it called? Your investment across multiple sectors. Now, the last way to diversify is geographic diversification, meaning you invest in multiple regions or multiple countries. You live in America, you can invest in stocks, in Chinese stocks. You can invest in maybe Japanese stocks and things like that. Now, you don't necessarily to buy. There are ETFs that actually have that focus on foreign markets. But if you're investing in foreign markets, you just need to exercise caution. Check, do the necessary due diligence, make sure that the country you are investing in or the specific company you are investing in is stable. But that's another way to diversify. Now, to manage risk, it's also important to have a regular review of your portfolio. While it may be okay to invest in an asset and just forget it, sometimes people say, just delete your password, just forget it. For an investor, maybe maybe you are investing for retirement. It may not be too bad, but at the same time, it's still not the best. It's important to regularly review your portfolio for two major reasons: for performance monitoring and for rebalancing. So performance monitoring is when you regularly review your investment so that you make necessary adjustment. For example, let's say one investment is not doing well, you reallocate funds from that investment to another investment that is doing well. That's performance monitoring. Then you can also do rebalancing, which is also reallocating funds from one investment to another one. But not this time around, it's not just because one investment is not doing well, but maybe because you have too much concentration in an investment, and that could be too risky. So you may want to rebalance. You should regularly check your portfolio. Your portfolio, if you will tell you if for example, if you have too much concentration in stocks, your brokerage could encourage you or suggest to you that, okay, maybe you need to invest in bonds as well, or maybe you need to invest in foreign stocks as well. So you rebalance. That can help to mitigate against risk. Now, there are also some hedging strategies, and I'm not going to talk more about these. These are the things I don't do: options, futures, inverse ETFs. I don't do them because as much as they have their, especially options, as much as they can hedge against risk, they also have their own associated risk. So options will basically give you the right but not the obligation to buy an asset at a particular time within a time frame. Futures, on the other hand, gives you the obligation. So the main difference between the two is that with options, you don't have an obligation. With futures, you do have an obligation. But the good thing is that the price is already set. So because the price is set, you are hedging against price increase. You must also invest in inverse ETFs. So what are inverse ETFs? They are the ETFs that actually move in opposite market, in opposite direction of an underlying asset. So when the price or the value of an asset is going on up, the value of inverse ETF for that asset will go down. But when the value of the asset is going down, the value of the inverse ETF for that will go up. So that could also be a way you hedge against risk. Now, it's also very, very important to stay informed. You need to keep up with the market. You need to regularly listen to or do research about the market, know what is going on in the market. Like, if there's a trend, you need to be involved. If, like, okay, maybe it's any season, you need to know because it could impact your portfolio. It's also important to stay informed of economic indicators as well. Like, okay, maybe there is the unemployment rate, the inflation rate, the interest rate, all of those will have impact on your portfolio. So you have to stay informed about them. Now, this might be the most important thing I'm going to talk about today. If you did not understand everything I've talked about thus far, you need to understand this. I believe it was either last month or the month before the last, I talked about the other types. And I gave you the different other types that are available when buying or selling stocks. I talked about market order, limit order, the stop orders, and trailing stops. I'm going to talk about them a little bit more. And maybe I'm going to show you how to use that in Fidelity and Weibo. Now, I struck out market order and limit order. I'll still talk about it, but the main purpose of this slide is rather than using market order and limit order, you may want to use stop orders and trailing stops. So, what is market order? When you're trying to buy a stock or you're trying to sell a stock, one of the things you have to set is the order type. So, what does market order indicate? Market order means that your trade will be executed at the next available price. Meaning, whatever, let's say you're trying to buy Apple, for instance, and you said, let's say the current price is, I don't know the current price of Apple, but let's say, which one am I? Let's say if you want to buy S&P 500 ETF, it's about 500 something, right? Let's assume that the current price is 540. You set it. If you set it to be market order, it may not execute at the price you see. The price it executes may be lower or it may be higher because you have set it to execute at the market price, which is the next available market. And I want to remind you, the price of a stock is set by like the forces of demand and supply. I talked about bid and ask. Bid is the price that you are certain that you want to buy a particular asset. Ask is the price at which the seller wants to sell the asset. Bid and ask have to be equal for a trade to take place. So now, setting your stock to buy or sell at market price, what it means is this. It's similar to you want to sell your house. You give it to a real estate agent and you just tell the real estate agent that, okay, I want to sell this out. Just sell it at any price you want. I want to believe that no one on this platform will ever do that. Rather than asking the agent to sell the house for you for any amount, you set the price for which you want to sell it. That's why I don't remember what year I used market order last. I've probably used it before, but it's been a long time. I never ever used market order because the price, especially for something that is that fluctuates, that is really volatile, the price could increase as trying to set the what's it called, set the trade. The price could increase, it could reduce. So that may not be the best. A slightly better order type is the limit order, in which case you set the maximum price at which you are willing to buy an asset, or the minimum price at which you are willing to sell your asset. That is a bit better than the market order, in the sense that if you are trying to buy and the price goes beyond the price you are at, the limit price you have put, your order will not be executed. If it's at that price or below it, the order will be executed. Now, the implication of the limit order is that your order may never be executed. So they both have their pros and cons. If it's important for you to buy the stock or the asset, irrespective of the price, well, maybe you can use the market order. But if you want to buy the asset, but the price is important, then maybe you want to use the limit order. But my main focus on this slide will be more about the stop orders and the trailing stop orders. So for the stop orders, we have two types. Now, I needed to explain market order and the limit order because the stop orders will can become either a limit order or a market order. Now, let's talk about the stop loss. Stop loss, we trigger a market order. Stop loss is basically, you are saying that, okay, when the price of, so there are two steps. First of all, the first step is trigger. The second step is the execution. You are setting stop loss when you say that, okay, especially when you already have the asset. You already have a stock, and you don't want to incur loss. Maybe you want to you don't want your profit to reduce, or you don't want your the loss to increase further, right? You set a stop loss. So basically, when you set a stop loss, you set a price. When the price of the stock reaches that price, when it falls to that price, the stop order will be triggered. But then the stop loss results into market order. That means when you set a stop loss, again, let's say an asset currently trades for $50. You set a stop loss for $45. When if the price of the asset drops to $45, the stop loss will be triggered. But again, the stop loss triggers a market order. Now that the stop loss has been triggered, since it triggers a market order, your investment or the asset will be sold, but at market order. It could be below that 45, or it could be at above that 45. That is stop loss. Stop loss will help you to reduce the loss, the potential loss of that asset. Stop limit, on the other hand, will trigger the limit order. Again, an asset is trading at $50. When you set stop loss, you have to set two values. The value at which it will be triggered, and the limit value, the value at which you need to sell it. So again, a stock is selling at 50. You set a stop limit for it. You set it to trigger at 45, and you say that, okay, sell it, and you put a limit price of, let's say, 45 again. When it is triggered, it triggers a limit order. Both the stop and the limit, you have set both of them to be 45. Your stop loss will never be executed below 45, because you have set a limit of 45. That means if it goes below 45, it will not be executed. If it's above 45, it will be executed. So the main difference between stop loss and stop limit is that stop loss will trigger the market order, stop limit will trigger the limit order. Now, so I gave you an example of an asset that sells at 50, that is currently traded as 50. You can set a stop loss for or stop limit for 45, right? Now, what if the price rises to 60? Do we still want to remain at that stop of 45, or do we want to go back and manually increase it? Instead of going back every time to manually increase or change the limits and the stop price, there is something called trailing stop orders. And again, trailing stop orders has two types. You have this trailing stop loss and the trailing stop limit. So basically, with trailing stop loss, you set a price that follows your security. Meaning, again, the price of an asset is 50. Your own risk tolerance is a drop of $5. If it drops below $5, you don't want to remain in that trade anytime, not just the current time that it is $45. So now when it is 50, if it drops to 45 or below, you want to sell it. But even when it increases in values to 60, at that point, if anything happens, it drops to 45 to 55. Instead of remaining at the initial 45, you want it to now be 55. Again, it's still $5 difference, right? So you said that's a stop loss. And again, stop loss, the main difference between stop loss and stop limit is that stop loss will trigger a market order. As long as the trigger has gone off, the next available price is, your assets, your trade will be executed at the next available price. It may be the price you don't want. It may be lower than what you expect. It may be higher. But for trailing stop limit, you set a limit that at which you want to sell the stock at any time. So whenever it drops by that limit, let's say by that $5, anytime it reduces in value by that $5, your trade will be executed. But the problem is, how do you determine what price to use? There's another way to do it. Instead of saying a specific price, you can state a percentage that anytime my stock drops by so percentage, I want either a market order or a limit order. But again, there's a problem. What is the appropriate percentage? Because there are days that a stock can drop by 5%, 10%, 15%. The following day, for whatever reason, it rises up by 20%. If you sell just because it dropped by 10% today, you will miss out on the 20% increase tomorrow. And I'm just saying day, it could be weeks, it could be months. So it's important to determine what limit price or limit percent you want to use. But let me explain trailing stops a little further. I found this image on fidelity.com that I think could explain it, because I know sometimes it could be confusing a little bit. So if you look at this, you invest in stock XYZ. You bought it at $25. And you think that, okay, your risk level is just $1, right? So your price, the stock increases from 25 to 27. At this point, you set a trailing stop limit or trailing stop loss at this point. And you give it a trail value of 1. Meaning, anytime your stock drops by $1, you want to quickly sell it because you envisage that it will drop more. So the current value of the asset is now 25. You set it that anytime it drops by $1 or below, it should a trade will be executed. So it increased as the value of the stock is increasing. The the trail will also increase. Meaning, if it increase to like, okay, let's say 27 to 28. Now the stop is no longer right now is 27. The stop will be 26. By the time it increases to 28, it's no longer 26. It's now 27 because it trails. That's where the name comes from. It trails the value of the asset. But then from 28, let's say it drops by like 0.5 or something. The trail will not drop. It remains the same. Then it starts to increase again to 29. And then the trail increases also to 28. If it drops from 29 and it drops to like, let's say 28.5, nothing, your trail will still stay at 28. Nothing will happen at this point. But when it now drops to 28, your trade will be executed because the value of the asset now matches the value of the trade of the trail. Okay, we have 5 minutes. Let me see if I can show you how to do that. We'll call again. This is the second time we'll talk about stops. We'll probably talk about it again, but let me show you how to do that on Fidelity and maybe even Weibo. So you are trying to trade a stock or ETF. You select the account. If you have multiple accounts, you select the account. You select the ticker symbol. Then you have the action. Maybe you want to buy or you want to sell, right? So you select the quantity. Then this is the other type. Probably have to select this. Okay. Selling. Okay. Now you see we've talked about market. We've talked about limit. Don't bother about conditional. Other. We'll talk about it. That's when one trade can cancel another one. Right, one order can cancel another one and things like that. We'll talk about conditional order later. You have stop loss, you have stop limit, trading, earn stop. If you want to use dollar value, you can use that. If you want to use percent, you can use that for trailing stop loss. If you want to use for stop limit, you may use dollar or you may use percent. If you use, let's just use if it is market, it executes at the next available price. If it is limit, you state the price. If you are selling now, you state the price that it will sell. It will never sell below that price if you give the price. If you are buying, it will never buy above that price. Now, if we change the other type from limit to stop loss, you just state the price. If it drops to that price, the market order will be initiated and it may not be executed at that price that you have set because it's going to be a market order. Stop loss always triggers a market order. Then stop limit. Now you see that we have 2 prices that you have to put. The stop price, the price at which the order will be triggered. That's the top price. Then you have the limit price. The price, if you are selling now, it will never sell below this limit price. Again, the same way you have stop loss, you can set the trail amount. Usually you make it based on the last price, but you can make it based on the bid and ask as well. And if it is percentage, set the percentage. If it is top limit, you have to set the trail amount again based on the last price. That's always better than bid or ask, or the trailing stop. You have to set the percentage. That's how to do it in Fidelity. Let me show you how to do that in Webull. So this is Webull. You want to sell and or buy an asset, you can create a new order. So you see the order, you right click a stock, create a new order. You see the order right now. I started this earlier to trade AMD. Now you see the symbol here. Now you see the order type and you see the different order types. The limits, you set the limit price. The market, you see that there's no price. It gets the next available price. That's where it's going to be initiated. If you set the stop, you have the price, right? Then trailing stop. Now you see you have the price, the trail, the stop price, and the limit price. Trailing stop, you set either the percent. You can change between percent and the dollar value here by clicking this. Then you set whatever you want. We have 1 minute. Let me show you another way to do this in Fidelity. If you, especially for an asset you already own. Just a moment. So let's say we want to let me bring this here. So you have a few assets that you already own. You want to sell, set a price at which it will be traded, right? You can again use either the buy or the sell. It will give you what we had the window we had before, or you can click this to set the exit price, the exit plan. And when you click it, it brings you to the trading dashboard, where again on the right hand side here you see sell and buy as well, and it's basically the same thing. You just need to set. If I click this, it brings back, and you can set the order type here. So it's basically the same thing. That's the end of today's discussion. Again, this stop part, the stop limits, the stop loss is very important, because once you set it, it will be executed on its own. That will help you. If you just buy a stock, you leave it, the price, just like I showed you earlier, the price maybe at a point is just 20% decrease. It could increase to like 90% decrease. You don't want that. By selling trailing stop and the stop and the limit, you're going to reduce the risk of the loss that you will incur in that trade. Okay, that's all I have for today. Any question, comment, thoughts? Questions from anyone? You can unmute yourself or you can put it in the chat. Okay, last time I gave an assignment, I'm going to give it again. Well, I said buy S&P 500 before next class. What I did not do, I didn't give you the ticker symbol. Now, you might be hearing of S&P 500. It could actually mean the index, right? But there's also S&P 500 ETF. There's S&P 500 mutual fund as well. Now, for S&P 500 ETFs, there are multiple S&P 500 ETFs. But the two most common ones are SPY. I'm going to put them in the chat. The ticker symbol, you have SPY and VOO. So you can buy either of those those. You can buy SPY, you can buy VO. You really don't need to buy both because they both track S&P 500 and their returns are similar. But if you want, there's no rule against it if you want to buy both. There are other ones, there are other S&P 500 ETFs beside those two, but those are two that I know have been doing well. And before we close, I know our time is up. Let me just show you one thing. SPY stock. S&P 500 in the last 1 year, it has gone up by like 36%. You can see it from like 450, I selected 1 year, 450 to like 576. It has gone up by like 36% in the last 1 year. So it's a good asset to invest in, especially for people who are just learning to trade. The risk is not as much as investing in individual stocks, but individual stocks have their own place as well. Okay, again, any question before we end the meeting today? Questions, thoughts? Okay, all right. I'll stop sharing. I mean, stop